you are going to want to take some notes because we're going to run through some of this. And some of this, we're going to run through this very quickly. Some of this is very basic for some of you, but bear with me. I'll probably say a few things you haven't heard before, but net worth is the measure. The term is net worth, right? What is net worth? The measure of everything you own minus everything you owe. And if you're in there counting shoes in your closet to come up with value for your net worth, then you're probably not far enough along just yet because we're talking about real real net worth here, right? Assets minus your liabilities, that's your net worth. Then we talk about income. Right? There's a lot of different categories of income. And I'm not talking about because there's many more categories than just three that the IRS has for different tax levels, right? The different levels of where you're taxed. Certainly there's numerous of those, probably 15. But for our purposes, when we talk about income, income number one is active income. That's where I'm working in a business, active business income that I'm working the front counter. For me, it was auto repair shops. For you, it may be something else where you're a technician within your own company. Technician is just a term, but that's just one of the terms that's used to name that, right? W-2 income, working for somebody else, or 1099 income because you're a specialist and doing some sort of, I apologize, S stands for specialist or self-employed, if you're self-employed, right? Passive income. Passive income is capital gains from the sale of an asset, appreciation of an asset. If I purchase a home, I own it for 3 years as a rental, it increases $100,000 in value. When I sell it, I get another 100 grand. I get 100 grand in profit. I didn't work for that necessarily. I had to have some skills. I had to have some advantages, but I didn't actively participate. That's what we call passive. And then PRI, or passive residual income. Some communities call it horizontal income. That's for things that come in what we call mailbox money, dividends, rents, royalties, things that I did something once and it continues to pay me. So those are the three levels of income. And then we have something in the community we call the vitality factor, also known as your cost of living, which for business owners, it's more than just your personal expenses, right? Because we run some things through our businesses, such as cell phones, such as a portion of our home, such as our fuel, such as our travel. And so it's your true cost of living, the things that you're running through your business. Like I'm a big proponent in having your own personal P&L. For those of us that have businesses, we have many P&Ls within those businesses if we have more than one. But a personal P&L to track my income that I claim as income, to track my outgo that is my expenses. But what's not going to be on there is the things that I'm running through my business. So the key thing is to make sure that you get those deductible business expenses included, so you know how much it's costing you to live every single month, every single year. Horizontal income is the best measure of your ability over time to convert your net worth into horizontal income. That's a horizontal income score. An example would be your horizontal income. That means your PRI, your mailbox money that's coming in every single month that you're not working for based upon investments that you've made, divided by what your total net worth is. That is your horizontal income score. Okay. And an example of that would be I got 100K coming in from my investments every year, and $1 million is my net worth. I would have a score of 10. And 10 is extremely high. This is just an example. Most people are in that 3 to 4 range on their horizontal income score, just to give you an idea. And then the nest egg theory. Freedom is a number. We do not subscribe in the nest egg theory in this community. This is what common thinking believes. I work and I work and I work and I work and I work, and I'm building over the period of my work life a bag of money. And then when I get to the top of that pyramid, I live off of that bag of money until I pass away. The challenge is we're living longer and longer and longer lives. Thank you to the progress of medical, right? So what is everybody's biggest fear with that nest egg theory? Is that they're going to outlive their money. And that's why we see a lot of people as greeters at Walmart in their golden years, right? And I'm not criticizing that. I think that'd be a fun job, quite frankly, but I would do it because I want to do it, not because I have to do it, right? So that's the problem with the nest egg theory. We believe in horizontal income, making investments that pay us month in and month out every single month. Okay. Financial freedom formula is my horizontal income divided by how much it costs me to live, my vitality factor. So if it's costing me, let's see, if this number is greater than 1.3, you are financially free and this accounts for taxes. In other words, if it's costing me $100,000 a year to live, and I've got $100,000 a year coming in horizontal income, mailbox money, then I am financially free if I add in that 30% for taxes. Keep in mind, we've got to pay our taxes as well. So if I figure out that I want to, if I figure out that it's going to cost me 100 grand a year to live, then I need 100 grand plus the taxes on that 100 grand. So a blended tax rate. And that's another term that's very, very important. The average rate at which you are taxed on all of your sources of income. Okay. So if in case you don't know this, a lot of people don't. I know it's pretty basic for some of you, but your W-2 income is if you got a job or you're in a business paying yourself as an employee, which you're required to do by the IRS, that is your highest tax rate. And then there's if you have a capital gain from selling a home, and like the example I gave a little bit ago, that is your lowest tax rate. It's closer to 20% as compared to 43%. So, and then tax drag. Tax drag, that is the wealth draining resistance. We talk about this in the community a lot, of taxes on your investments and earnings that cost you cash today and robs you of the future compounded earnings of those lost dollars. So it's more than just paying taxes. Okay, let's say you pay $20,000 in taxes unnecessarily because you don't have a good tax strategy in place. It's not just the 20 grand. It's that 20 grand at 8% compounded over the next 20 years. How much did you really lose? So that's where tax drag really steals our ability to create wealth, because the magic in creating wealth, guys, is compounding. It's the runway. It's the time that we have that money out working for us. Okay.